This is the 2025 Forex Trading Empire Mentorship Program, Lecture 14. The topic for this lecture is daily bias. So in the previous lecture, we discussed on how to trade the weekly bias, and in this lecture, we'll be going through the daily bias. On the daily bias, first we'll be discussing on how to anticipate the next daily candle. Remember, I told you guys to grow the skills of learning how to anticipate the next candle from any time frame, from the 1 minute, the 5 minutes, the 15 minute, 1 hour, 4 hour, daily or weekly, because this is going to be helping you in your bias. It's going to be your overall way of determining bias. So learning how to anticipate the next daily candle is going to be helping you on your daily bias, learning how to use other time frames and the daily time frame to determine the next daily candle. Next is lower time frame trend confirmation. Understanding the lower time frame trend confirmation. What are a lower time frame which is being needed to confirm the bias if price is trading to your direction, trading to the next drawn liquidity you identify from the daily time frame or from the 4 hour time frame. Next is daily profile. We talk about the daily profile and what we're anticipating individual section to do, and what are the parameters of us trying to catch the daily range. And we'll talk about daily bias scalping setup. You can use the daily bias for scalping setup. I think when it comes to scalping, in order for it to be a good scalper where you can scalp on the 1 minute or lower, using the daily bias for your scalping trades, I think is the best, because I've used it multiple times in taking trades. When you use a scalping bias from other lower time frame, it tends to give you few moves. But when you're using the scalping bias from a daily perspective, it gives you a long range where in some cases you might catch the daily range. So using the daily bias for scalping setup is one of the biggest way to maximize your profit. Now, daily bias. We'll be talking about the steps in which you'll be taking to determine your daily bias. First, use the daily time frame to anticipate the next daily candle by using the PDA matrix. Now, using this daily time frame to determine the next daily candle, you can use the weekly and the daily. I didn't include it in the steps, but you're using the weekly, you're using the daily. You're trying to get enough information to determine the next daily candle. Pairing those time frames together is very important, which going further, when I'm doing daily bias, I will show you how you can use both time frames, how you can incorporate both time frames to determine your daily bias. To anticipate the next candle using the PDA matrix, understanding the premium and discount array for you to determine your daily bias. For lower time frame confirmation, use the 1 hour and the 15-minute time frame trend to see if it's aligned with the daily bias and follow the trend for confirmation. We'll be using the lower time frame, the 1 hour and the 15 minutes. We'll look at the trend to see if it's aligned with the daily bias. Because if you're looking at the daily bias from lower time frame perspective, we're trying to determine the lower time frame bias. So we'll be using the 1 hour and the 15-minute time frame to determine the bias. That's what we're going to be using on the lower time frame. And to confirm if they are aligned with our bias, because if they're not aligned with our bias, you might just avoid the whole day. Don't even trade throughout that day, because going against the trend, I've tried it multiple times. It's very detrimental to your PNL. So for entry, we're using the 15-minute, 5 minutes, and the 1 minute time frame with section. We need to align ourselves with the proper section, because you need to understand the daily profile for you to align it with the section. So we'll be putting each section in consideration before taking any trade. Because once the 1 hour and the 15 minutes is ready to expand to your direction, you need to know on which section price is trading on. What are your expectations on this section? Always take note of the daily profile and see how the price action is aligned with the daily profile. We're going to talk about the daily profile. There are few daily profile. There are some profiles where the last section creates the high of the day, but we'll be talking about the more basic one before we move into more complicated daily profile, which we'll be doing that in the trade reviews we'll be doing in the 2025 mentorship program. Try to name those reviews by the daily profile that is occurring that day. So make sure to take note of the medium and high impact news because markets will use those days to complete the weekly delivery. Now it's still the same with the weekly bias. You need to note the days where there are high impact news because days where there are high impact news, that section which holds those high impact news, price is mostly going to consolidate till they get to that section before they run out both side liquidity before the distribution once the news comes out. So understanding the medium and high impact news is very important. You know days where there are high impact news, and if you are trading during those days, you make sure you try to align it with the high impact news. When in most cases, you just need to wait for them to release the news. If they have had any news before that news, then you look for your entry and hope for the news to trade to your targets. But if there haven't been any news throughout that week, and that's the first news, then you might, which in most cases, you just wait for the news to be delivered. And after the news has been delivered, then you wait for your entry after the high impact news. Now let's talk about daily profile. Now let's talk about a classic buy day. Now these are days where you're anticipating higher prices. If you're anticipating a bullish day, this is what you need to keep in mind. London will create the low of the day. New York will continue, will do a trend continuation and close. We call this OLHC, which means open, low, high, close. It's just a simple form OLHC. Now I've talked about this a few times in previous margin, the 2024 mentorship program. This is talking about a classic buy day. When you are looking for an up close daily candle, remember an up close daily candle, not trying to see if price is going to trade to a liquidity pool before a retracement. We're talking about a classic buy day where you are looking for higher prices that day. London will create the low of the day. New York will create a continuation and lead to the closing of the candle at 12 p.m. New York Eastern Standard Time. Now, there are specific Q zones we do trade. I'll be talking about those Q zones. I've talked about it previously. Each currency pair has its own Q zone and it do have its own major daily profile. Now, this profile is specific to pair that are correlated with the euro and dollar. So, euro USD, this daily profile fits it correctly. GBP USD, this daily profile fits it correctly. So understanding this daily profile is understanding the currency correlation. When it comes to currency correlation, this daily profile is specific for Euro USD. Let me just state it. Specific for Euro USD and GBP USD and the dollar index because it's still somehow correlated with the euro index. So you can still use this on the dollar index. But remember, these are the those are the section those currency best performs on the London and the New York section. If you were to trade the Euro JPY, the first section, I'll be looking for price to create the high or the low on the first section. If I'm looking for higher prices, the first section I'm anticipating price to create the low of the day, while the second section I'm anticipating a trend continuation leading to the close of the candle. You need to learn how to correlate it. There are some times where after the continuation, close to the closing price might do a complete reversal or do a complete retracement back to the daily range. But we'll talk about more daily profile and I'll find a way to best explain how to use how to understand multiple currency correlation of daily profile, understand each currency daily profile. But on Hero USD daily profile, from the opening price below, which is the opening, low, high, close, this is what we're anticipating, the power of three. If you apply this correctly, this is the power of three. But we are anticipating price to do the manipulation during the London section to create the low of the day. So when price is creating the low of the day, it's going below the opening price, which means price is at a manipulation phase. So we are trying to catch the manipulation phase after the shift in market structure from the London section, which you can best see it on the 15-minute and the 5-minute. If you're looking at those time frames, you can quickly identify that shift in market structure that led to the daily bias, that led to the daily expansion, which is the distribution phase. So the distribution phase, you're expecting or anticipating a trend continuation during the London section, which I did like a pullback. And this London section, I've talked about the London section from the 7 a.m. to the 10 a.m. During this time, you're looking for a retracement back to the London range. When it does a retracement back to the London range, mostly it's on a 15-minute fair value gap. Price will use that reference discount point to continue the trend, while sometimes it's the 1 hour. So you can look through those two time frames for that trend continuation on the New York section to catch that trend. Although there are two specific micro that do occur during the New York section, we're going to get into specifics on further margin. I think we're already close to that margin, to that lecture for me to discuss about it. So the retracement back to the London range, then you're looking for a trend continuation during the New York section to create the high and the closing price, which will form a complete daily candle, daily up close candle. So open, low, high, close. Now let's go to the chart. In this chart, we'll be using let me just say, a hand-picked um, day where there's a clear daily delivery, because there are some few daily profiles that makes it more complicated to understand. Price doesn't create an exact copy. If you understand price delivery correctly, price doesn't create an exact copy. It creates a similar copy. Similar, not that similar. They only have the same characteristics, but the way price is going to be delivering it is going to be way different from today or the next day you are seeing price traded to that direction. So that's why I'm going to use a hand-picked price action, which is very easy, that best explain what I'm trying to explain. So let's go to the chart. This is the daily time frame of Hero USD. And this daily time frame, I'm using a trade replay to set it at the specific candle I'm trying to explain on. I told this guy this is going to be a hand-picked candle, so that I can talk about the bias, first about the bias before the lower time frame entry. The reason I'm using a hand-picked candle is because the Hero USD have been on a downtrend for a while. So it's not that easy to find a clear up close candle where price has the whole criteria to what I'm trying to explain. So it's better for me to just make it more easier, talk about a hand-picked candle that I've checked it already before even doing this recording, which actually took the trade on this candle. I talked about it in the chat room, but let's dive deep on how I determine the bias to buy during this day. So we're talking about this candle. So first, if you're using the PDRA, I like to use from the weekly and the daily, aligning them correctly. On the weekly time frame, price did a trade lower, retracement to this fair value gap. And after this retracement to this fair value gap, price traded lower, run out sell side liquidity. I'm not going to identify the sell side liquidity. You all know that this is sell side liquidity. Price they run the sell side liquidity. Now, if I'm to apply the PDRA, if I'm to apply the premium and discount, you know that price is on a deep discount. taking out this discount sell side liquidity. So if I'm to use a Fibonacci, price is below the 50% level from the weekly time frame. You see, I'm getting information from the weekly time frame. It's not that I'm using the weekly time frame as the only bias to determine an individual daily candle. Then I go to the daily time frame to see if this downtrend is going to continue. Now, on the lower time frame, before price created this candle, let's just do it like this. Before price created this candle, price at a discount. Now, between the recent swing high and swing low from the daily time frame, make sure you adjust your Fibonacci to the recent swing high and swing low. Since there's no reference point, there's no weekly reference point to reference to if price were to retrace higher. So that weekly reference point, we'll be looking at the daily reference point. Now, at this daily reference point, before price created this candle from this recent swing high and swing low, price is below the 50%. Here's the 50% level. Price is below the 50%. And price took out a sell side liquidity, a discount sell side liquidity. Now, we'll call this a counter trend. This is trading against the initial trend because we're on a downtrend, but I'm looking for that resistance, or let me just say that support level where price will be using for a retracement back to the dealing range before expanding again, going lower, like what price did here. After this downtrend, you can see that the two upwards candle back to this other block before this trend lower. So I'm trying to anticipate when price is going to go for this retracement. That's what I'm trying to anticipate. So I'm looking for a trend reversal. So always determine what is the candle doing. Is it a trend continuation candle or is it a trend reversal candle? I'm looking for a trend reversal, just a little reversal to a daily reference point. And the reference point was this order block. Here was the reference point. I was looking for price to trade to. We're going to market order block. So the daily reference point is this order block, 2 up close candle, and this fair value gap. That was the two reference points I was looking at. If price were to retrace back, so the daily range, this will be the reference point I'll be looking for price to expect. Now, I have talked about previous day and previous day high, previous day low. In this scenario, if price were to do a retracement, I would like for price to run out some sort of liquidity, some sort of higher time frame liquidity before going for this other block. That was my thought process, in which I'll be looking for price to run out a previous day low before doing a retracement. You can see the same thing happen at this candle. Price day retracement, run out previous day low before doing this retracement to this fair value gap, before respecting the fair value gap. In some instance like this instance, price did not run out the previous day low, which is okay not to even take any trade during these times. As long as price doesn't run out the previous day low before the retracement back up, you avoid it because price is not in any reference point to anticipate higher prices. We are looking for confluence before looking for higher prices. And after that run on that previous day low, you need to see a shift to market structure on lower time frame, which I'll get into it. I'll get more on it once we go to lower time frame. But the idea is that price traded through this discount sell side liquidity, price at a deep discount, and here's the daily range, the PDR, the premium and discount range, and I've placed my fib knowing the 50% level, knowing that price is below the 50% level, and I'm anticipating price to do a retracement to this order block or fair value gap for price to continue the downward trend. Now let's go to the 1 hour time frame. I'll be showing the complete candle, showing what our price already done to explain it more better, but I'll try to explain everything you need to know about the daily profile and the daily range. So let's go to the 1 hour time frame. Now here's the opening price of the candle. Here's the previous day low. On the 1 hour time frame, you're trying to look at price on to look at the higher time frame reference point. Now, in this scenario, we are anticipating higher prices. If we're anticipating higher prices, we're looking for an all close candle. Here's the opening price of the candle. The opening price of that day. You mark up the opening price because we're going to use this opening price as the equilibrium price. Below the equilibrium price is a discount price. Above the equilibrium is a premium price. On this 1 hour time frame, you are looking for a reference point below the equilibrium price, below the 50% level. The reason is that you're looking for a reference point for price to trade, to either trade into a fair value gap, to fill the fair value gap, a discount fair value gap, because at that moment, price is trading to a discount. And if price going for a discount is at the manipulation phase. And those discount liquidity will be used to push price higher. Price traded lower. In this example, the liquidity below the opening price is the previous day low, which is going to be a sell side liquidity, a discount sell side liquidity. Now, opening price, where's the next drawn liquidity below if price were to do a retracement lower? Daily low. So now you have identified your 1 hour premium liquidity and discount liquidity. If price were to run out this daily low, where will be your target? Above price, you can see there's an equal high, this high, and this high. This will be a target. And if price were to run out this target, what's going to be your next target? Fair value gap. You're using this time frame to determine your target. Where's the fair value gap? Here's the fair value gap. When you are taking lower time frame entries, all these reference points you're identifying will be used for your target. Now, if price were to trade to a discount, now going back to a premium, where will be your next draw on liquidity? The buy side liquidity, the premium buy side liquidity, and the premium fair value gap. You'll be looking for price to trade to those areas. So in this, what I'm trying to explain is that you're using the 1 hour to determine your trading range, where you are looking for price to trade down to a discount to, where you're looking for price to trade to a target to. What are your targets and what are your parameters that price is trading against you? Because if price haven't taken out this daily low, you're not looking for any higher prices. You need to see price run a discount liquidity, which is the daily low, which means accumulation, manipulation, and a distribution. And if price were to distribute higher, creating the daily range, where's going to be the drawn liquidity? The buy side liquidity, the equal buy side liquidity above the opening price. And if price were to run at this buy side liquidity and there's still opportunity for price to trade higher, where will be your next drawn liquidity for price to fill in this fair value gap? So you can see how using multiple time frame makes sense. Now let's go to the 15 minutes. The 15 minutes is actually the time frame you're waiting for your shift in market structure and a clear bias. Let's go to the 15 minutes. Now in this 15 minutes, we're going to go through it carefully because I'm trying to point out some characteristics when it comes to a shift in market structure. Now first, price did an accumulation, manipulation, took out the daily low. After the run on the daily low, price did a shift in market structure. Price did a retracement, looking like it's going to respect the order block. It failed. Price traded through the order block, did another trade higher, but this is not a reference point or reference to because there's no fair value gap when price was trading higher. Although there was an order block, but you can't verify this order block as an order block you'll be capitalizing on. So price came back, traded lower one more time, took out this swing low, and did the shift in market structure before a trend higher to run at the buy side liquidity. The 15 minutes will give you a clear perspective of the daily trend. Gives you a clear perspective of the daily trend. Now let's add on section. Now during the London section, I told you guys the London section will look to create the low of the day, which means you're going to look at this swing low as a liquidity. Price took out the daily low. London section opened at 2 a.m. Price did a trade lower, running out the Asian low. This is going to be an Asian low. Price run out the Asian low, created a high. Since there's no fair value gap to support price, now you can see how adding up section validates this setup, telling you to avoid the first setup and not to take advantage of the second shift in market structure, to look at it as a shift in market structure. Price did the retracement, run out the sell side liquidity because now it's like an equal low liquidity. An equal low liquidity below price. Price traded through, run out the equal low liquidity. Now, price created the low of the day during the London section. London section, price traded higher, retracement, created a high. Now, price have shift structure from this downtrend now to an uptrend. After this retracement, this is where you'll be taking advantage of. After this retracement, now we're getting to the New York section. We're looking for a trend continuation of this shift in market structure. We're looking for a trend continuation on the New York section. The New York section created a new high, retracement, respected it, and price used the remaining closing section from 10 a.m. to 12 to set price for price to do a complete daily delivery. Now, this is because the current contract we're currently on is favoring the it's favoring the New York time. The New York time is mostly highly volatile during this time. So price is mostly going to move during during the New York AM and PM section. So price used the AM section of the New York section for the complete shift in market structure and used the PM section of the New York section to do a complete run on the buy side liquidity. I know you guys are hearing about AM and PM section. I'm going to talk more about it once we get to the US 100. Now we are talking about Forex and Euro USD. But those volatility still applies to the dollar index. And if the dollar index is correlated with Euro USD, price is going to react to it. But it doesn't happen all the time. It's mostly around early of the year, during the January time, that you can find price actions like this or find scenarios like this. But later on, the London section and the New York section will still have some sort of close approximate liquidity to work on, and to make it more easier for you to execute on your trades, to find those good setups. But price went lower, run on sell side liquidity went below the previous day low, shift in market structure. Now, after the shift in market structure, we're going to go to the 5 minute to look for the entries, but you can execute straightly from the 15 minutes. Now, price did retracement, created a high, created a low, created another high. Now, this is a shift in market structure. From this swing low to a swing high, the candle that did a state in change of delivery, 3 down close candle, and order block. You can use the fair value gap above, or you can use the order block directly. Whatever reference point you choose on using, you can use it. But I'll be using the order block. So here's the order block, the entry price of the order block, and let's mark this order block. Here's the order block. You can execute straightly from this time frame. Place your stop loss at the recent swing low on your entry level and your target above the opening price, the 1 hour reference point as your target, and we can see an easy executed trade. Now let's go to the 5 minutes. Let's go to the 5 minutes and look at more micro entries. We're going to do more example, more live example when there's a good scenario to explain this more better. Let's go to the 5 minutes. After the shift in market structure, that's what we're going to be looking at, because you need to see the 15-minute shift in market structure before you use your 5 minutes for execution. Let's go to the 5 minutes. Now, on the 5 minutes, here's the shift in market structure. Now, after the shift in market structure, look at where price shifts structure, retracement, back to the other block. Now, at this shift in market structure, you can see a 5-minute shift in market structure inside the shift in market structure from the 15 minutes. Price day retracement, traded to the other block, swing high, swing low one more time, running up this low, created an internal trend, retracement, leaving this other block before this impulsive candle. After this impulsive candle, the next candle came back with a wick to tap the other block, and this would have been an entry, but at the beginner stage, I would have advised you guys to use this as an entry. But price later created a new swing high, left at a fair value gap. You can see there's a fair value gap here, and there's a fair value gap here. Retracement to the fair value gap, respected the fair value gap, and that was how price traded higher to your targets. So if I were to use a position tools, this will be your target, and for price to, so let's do it like this, and your entry. This is not much of a big R trade, but when you are taking trades like this with the right entry level and the right mindset, you can easily to be profitable with a 1 to 2 R. A 2.5 R is a big trade. It's a big trade when it comes to using multiple time frames like this. There are some times where you'll be having 1 to 5 or even more. When it comes to daily bias, having a 1 to 2 R is still better. On an average, having a 1 to 2 is still better. You're still profitable as long as your win rate is higher than your losing rate. So this went above the entry levels I was trying to explain from the New York, from the London, the New York, and the PM section. The reason it was because of what I explained about the currency pair. Those are mostly based on contracts. When you understand the fundamental side of things, I'll talk more about it later on. Then you will be expecting a trend, a high volatility trend during the PM section of the New York section. That was what led to this whole trade idea. But I executed on the 15 minutes. I used this order block to execute the trade. Now, during the London section of in the 5-minute time frame, you can see there's a few swing highs to a swing low leading to this downtrend, consolidation, retracement, order block, respecting the other block, creating a new high. This was when price was going for this daily low. Price was still looking to proprietary trade to this daily low. We're expecting a 1 hour fair value gap. That's what led to this lower time frame when you look at it from a 5-minute perspective. We'll be doing more example on this. I think this video just help you to set up a basic side of things. I'll do more on the daily bias. We're still going to talk about more about daily bias, because I think the next 3 or 4 lectures is going to be more about the daily bias. But this is the best way to apply the multiple time frame. You use the weekly and the daily time frame to determine the next daily candle. You use the 1 hour to know your reference point above your premium and discount reference points from the opening price. Then you use a 15-minute to validate the trend on where you are trading to see if price on an uptrend or a downtrend. Where is price looking to trade to? because looking at it from a 15-minute perspective, you know the price was trading lower to run out this sell side liquidity, and the entry was actually clear on the 5 minutes. Shift market structure, retracement, other block, respected the other block, downtrend. Now, after price took out the previous day low and this equal low, you can see how price did the shift in market structure, which the 15-minute clearly showed the price has shift structure before this retracement to the other block, and buy respected the other block and traded higher to run out the buy side liquidity. So you can see how the major time frames are really helping you on how to apply the multiple time frame. That is one of the big purpose of me even talking about it. But we do call this daily profile. It's mostly based on time. It's called the 3 a.m. to 5 a.m. retracement. So there's a retracement that do happen during that time. And after that retracement, we're anticipating price to consolidate a few pips in during the New York section before the complete expansion. So it's called the 3 a.m. to the 5 a.m. reversal. That's the name of this profile. I think that's the name I personally gave it because on my own personal journal, those are the names I do identify when I identify a daily profile. Because the London trend price is going to go completely against the London trend when that reversal occur. Here's the London trend, price traded lower. Now, once the reversal happened during the range of 3 a.m. to 5 a.m., you can see how price traded back to the London high. So it did a complete reversal. I'll talk more about more daily profile as soon as on any example I'm doing. I'll talk about the name of the daily profile and the weekly profile. So make sure you jot it. So let's go to a classic sell day. Now, classic sell day. If you're anticipating a bearish day, this is what you need to keep in mind. London will create the high of the day. Remember, London will create the high of the day, and the New York will lead to a trend continuation and a close of the candle. We'll call this open, low, high, close. So in the diagram, open, high, low, close. This best explain it, why leading to a bearish candle. So it's still the same thing to the classic buy day, just opposite. We are anticipating higher for London to create the high of the day during the London section, and we are expecting the low of the day during the New York section and a trend continuation during the New York section to execute. And if you're looking to catch the whole daily trend, it's mostly going to be looking for an entry from the London section. But if you're a trader that trades only on the New York section, you're looking for a trend continuation, a retracement back to that London range, retracement to a 15-minute fair value gap, execute on that fair value gap, lead to a trend continuation, and price will create the low of the day, a retracement back to the complete daily range, and close. While in some example, price might do a complete reversal. We'll still talk about that profile. It's called the 8:30 to 10 p.m. reversal. So we'll talk about each of those micros and how they do operate. Those ones are mostly used during high impact news. We're going to talk about it later on. So let's go to a chart example and let's try to illustrate on this. Remember, this is the hand-picked example. I'm just trying to look for a best scenario to explain it more better. And since the Hero USD have been on a downtrend, there's a whole lot of example when it comes to looking for a classic sell day. So let's go to the chart. Still on Hero USD, and the daily time frame of Hero USD, and we're looking at the classic sell day. Now in this example, let's talk about buyers first. First, let's look at the weekly time frame. On this weekly time frame, you can see from the recent reference point, price traded to a day's count, a retracement back to this fair value gap, Now, since price retraced to this fair value gap, price respected the fair value gap, which you can clearly see. The weekly candle did a doji candle, down close candle, down close candle, down close candle. Now, this is because I'm using a replay, but at the time at the specific candle I'm trying to identify is only showing that price haven't run out this swing low, but this was our target. Now, seeing the price is creating a down close candle, where is going to be the next drawn liquidity? Sell side liquidity, sell side discount liquidity. So we are looking for a trend continuation. Now, we have looked at the weekly time frame. Now, this weekly time frame, to point out where at the important area to look, we should look at is to look at the weekly reference point that is still influencing the price or still pushing price. Can you use that word? This fair value gap is still pushing price lower, and the next drawn liquidity on the weekly time frame is this swing low. So understanding that it's going to be the next drawn liquidity, you're looking for price to run to this liquidity. Now on the daily time frame, this is where you determine if price is ready to trade to that area or creating a down close candle to that area, which on the daily time frame you can see the price haven't run out the sell side liquidity. We're going to call it a discount sell side liquidity. So call it sell side liquidity, discount sell side liquidity. Now from the recent swing high to a swing low, using your Fibonacci, swing high, swing low, press the retracement higher above the 50%, so there's fair value gap. And since price traded to the fair value gap, price haven't closed above the mid-range of the fair value gap. So try to look on how price is reacting to a fair value gap. Price haven't closed above the mid-range. Price respected the fair value gap, went back to 25%, the quarterly range of the daily range. Price came back, run out the high, went to the mid-range of the fair value gap, but immediately price resist, traded lower and traded away from the fair value gap, closed outside the fair value gap. Now, this is a clear indication of the next candle to be a down close candle. And the next candle is going to be a down close candle, where it's going to be the next draw on liquidity, previous day low, and other daily liquidity. This is why I told you guys to take note of your previous day high, previous day low, looking on what area you're looking for price to trade to. Is that price going to trade to the previous day high or the previous day low? So let's take this fib out. Now in this previous day high, this is going to be our first target. We're looking for price to run out this previous day low. If price were to run out this previous day low, where's going to be our next target on the daily time frame? Sell side liquidity. We're going to look for price to trade to the sell side liquidity. Now, in this daily time frame, we are anticipating a down close candle, which you can clearly see is a down close candle. I just wanted you guys to see it beforehand while I'm pointing it out. We're looking for a down close candle. Now we're going to go to the 1 hour time frame. Apply it how we did on the classic buy day. So let's go to the 1 hour time frame. On the 1 hour time frame, before I start the explanation, you can just use your eye or try to pause this video to look at this chart and try to see areas that I'll be pointing out and what I'm looking for in this 1 hour time frame. Now the purpose of this is for you to understand what I'm using each time frame for, each individual time frame for, on the daily profile, daily range, or weekly range, whatever time frame. I'll be doing this a lot on further lectures. Now, if you have paused the video or if you haven't even done it, but I advise you guys to do it most times. From the opening price, we are looking for price to trade to a premium price so that we can sell from that premium price and anticipate lower price for price to run at the previous day low and even go for the daily time frame sell side liquidity. I told you guys that first you identify the opening price of the candle, The opening price is your equilibrium price. Then you mark out liquidity above the opening price as our opening price. Here's the opening price. Above the opening price, where's the liquidity on the 1 hour time frame? You can see that there's a fair value gap. You mark out the fair value gap. This is a premium fair value gap. And a premium fair value gap, if you're looking for lower prices, you want to see price trade to that premium fair value gap. For those that doesn't understand power of three, here's the classic power of three. A retracement to the fair value gap, we're expecting the fair value gap, manipulation, then the distribution lower. Where's your target? Previous day low, and sell side liquidity we identify from the daily time frame. Easy to apply it. Now we have marked out the premium reference point. Now on the discount reference point below the opening price, where are the next drawn liquidity? Daily low. And after this daily low, where's the next drawn liquidity? Clearly you can see that it's this sell side liquidity. Now I could have marked this as sell side liquidity, but still it's still aligned with the daily low. If there has been any other 1 hour swing level, I would have marked it before identifying this daily low. But since there's no reference point, we're looking for price to trade to this daily low. Now you can zoom a little bit. There's a reference point, a fair value gap below price. We'll be looking for price to fill through this fair value gap. This might be like a partial, where you take partial or look at it as your first target before looking for another setup to look for price to trade the daily low, or where you'll be trailing your stop. Whatever way you use in managing the trade, I'll explain ways I use in managing my own trade personally. Then you can find a way to align it correctly. Now it's time for us to go to the 15 minutes and apply structure and section. Let's go to the 15 minutes. Now in this 15 minutes, you can see the trend clearly on the 15 minutes. You can see the trend. Opening price traded to the mid-range of the 1 hour fair value gap, respected it, shift in market structure. You can see the shift in market structure. Let's mark this red. Shift the market structure to this fair value gap, and there's still an order block. You can see how price traded lower, filled the 1 hour fair value gap, traded lower, run out the previous day low. Now this is a classic sell day. Let's apply section. During the London section, price did a retracement higher to run out. Remember, we are looking for the London section to create the high of the day. Remember, to create the high of the day, most people get this confused. We're looking for London section to create the high of the day. Price traded higher. Price above the opening price. Traded higher, created the high of the day. After creating the high of the day, we are looking for a shift in market structure before going to lower time frame. Price did a shift in market structure. Now you can go to the 5 minutes to look for your entry. That is, during this time the price is trading lower, you're on the 5 minutes looking for an entry. Now this is still called the 3 a.m. to 5 a.m. Reversal. So price will do a shift in market structure during this time range, and you're looking for price to respect the fair value gap the price will be creating during that time. That will lead to lower prices. Now in this 15 minutes, you can execute directly from the shift in market structure, which will be a trade like this. Target the previous day low, and 1 to 3 hour, still a good trade. And you can still zoom closer. You can see after price respected the fair value gap, created a new swing low, retracement. Here's the fair value gap again. If you have missed the first entry, there are still many ways to take advantage of it. Retracement to this fair value gap, respected the fair value gap, price traded lower, use this candle, retracement to this fair value gap, respected this fair value gap, created a new swing low, retracement again to this fair value gap, respected the fair value gap, and traded lower till price run at the previous day low. So you can see there are many instances for you to take advantage of this setup. but we're going to the 5 minute to align both the 5 minute time frame, and we'll talk about scalping, how to scalp on the 1 minute. I forgot to talk about it in the classic buy day, but let's talk about it on the classic sell day. But first, let's go to the 5 minutes. Now, after that shift in market structure, you're just looking for 5 minute entry. You can see retracement to the fair value gap. Here's a shift in market structure. Shift in market structure, this will be your entry. Where are you looking to target? Let's make this blue. Where are you looking to target? You can use this fair value gap as a first target, then look for lower price or price to run on the previous day low. Whatever target you choose on using. But this is a 5 minute entry after the shift in market structure on the 15 minutes. Sell, retracement, fair value gap. You sell, retracement, order block. After price traded through this fair value gap, price left an order block. Retracement to the order block, you sell, lower prices, and fair value gap. So you can see there are many instances for you to take an advantage of this setup. As long as you understand the price delivery, there's a whole lot of areas for you to take advantage of. And lower prices, sell off this fair value gap, price to our target, daily low. After running to that daily low, you can see price still traded lower to the sell side liquidity before a little retracement after the closing of the price range. So this is a classic sell day, consolidation, run on liquidity, shift in market structure, 15-minute entry, and 5 minute multiple entries for you to take advantage of. Targets, we already identified 1 hour target, fair value gap, and previous day low. All you have to do is just take the trade. If you have taken one of these trades, you can just hold on to this trade and throw your stop as price creates more entry level. You throw your stop to the high after price created this fair value gap. Price create another fair value gap and order block. You trade your stop to this high, respected it, traded lower, and to our target. And this is around 4.7 hour 4.7 hour trade, and this is a very great trade. If you can catch this, let's say like 4 times, I can even say 4 times a month, because you're not going to be taking a whole lot of trade using all these ideas I'm talking about. These ideas are specific things you need to wait for before executing your trade. So you need to be patient enough to wait for the price to be fully aligned with your trading plan. And you can watch the video a few times, look on how I apply it correctly. Now, how to scalp. Now, the scalping, you'll be using the 15-minute and the 1 minute. The moment price did a retracement to this fair value gap, you're going to the 1 minute to look for a shift in market structure, to look for that trend coming lower. Since you're using the 1 minute and other lower time frame below the 1 minute, the 30 seconds, if you're going lower than 30 seconds, then you look for your entry. Your target will be 15-minute swing level for you to take profit. Entering again, you're still using the 1 minute, and you can look at multiple areas where price do a retracement and you're looking for a 1 minute shift in market structure. You can even target higher time frame targets. I'll be doing live example on executing on his scalping trades on further Madra. So I already gave you guys the idea. You already have a bias. You're just looking for price to retrace to 15-minute reference points before going to the 1 minute to look for your entry. So learn how to frame your scalping trades if you want to be a scalper. But day traders, swing traders, and intraday setups, these are the trades you'll be taking advantage of once the daily bias is aligned with your bias. So make sure to go through this video a few times, watch it a few times, and practice on it. apply it correctly. I've talked about the complete daily profile when applying multiple time frame. Mostly you can apply it correctly when you're using it with the Hero USD. Try to apply it correctly, it's very important. Practice on it. Watch the video a few times to understand it more better. And that is all for this lecture. See you guys in the next lecture.